What if the account you trust to protect your money is actually shrinking it every single day? Welcome to Auravale, a city where every financial decision leaves a visible mark on the skyline. Here, APY, annual percentage yield, is the number that determines whether your district grows or crumbles. It measures exactly how much your money earns in 1 year. Here's the uncomfortable truth. Most Americans park their cash in a big bank savings account, earning just an average APY of around 0.38% to 0.42%. On $10,000, that's exactly $1 earned in an entire year. $1. That's the deal most people silently accepted. Meanwhile, inflation, the slow rise in the price of everything around you, is measurable and relentless. The U.S. Bureau of Labor Statistics reported the Consumer Price Index averaged 3.4% in 2023. The real cost of goods climbs while your savings balance barely moves. Your money is losing a race it didn't know it entered. Run the numbers, and the gap is brutal. Inflation at 3% erodes roughly $300 of purchasing power from a $10,000 balance every year. Your account statement shows no loss, but your wallet feels every cent of it at the checkout line. Here's where it gets harder. Your deposited cash doesn't sit idle. Banks immediately lend it out across Auravale's borrow badlands. Mortgages, auto loans, personal credit. Credit card APRs at major issuers like Chase averaged over 20% in 2023, according to Federal Reserve data. The gap between what banks charge borrowers and what they pay depositors is called the spread. It's the engine of bank profitability. The Federal Reserve's Q4 2023 data put the average credit card rate above 20%. Banks return 0.01% to you and pocket the difference as institutional profit. A common misconception is that this is simply how banking works, that you have no bargaining power, no real choice. That's false. The spread is a business decision, not a law of physics. Competition in the financial market means you can choose who gets to profit from your money. Enter the high-yield savings account, the HYSA. These accounts, offered by online banks with lower overhead costs, currently pay between 4 and 5.00% APY. That's $400 to $500 earned on that same $10,000 balance every year. Compare directly. The traditional big bank account returns $1 per year on $10,000. The HYSA returns up to $500 on the same balance. That's a $499 difference for doing nothing more than opening a different account. Here's a question most beginners never think to ask. What happens when that interest itself starts earning interest? This is compound interest, the mechanism that turns a modest rate advantage into a wealth gap that widens every single year. Compound interest is one of the most powerful tools for building wealth over time, especially when engaged early. At 5% APY compounded daily, $10,000 grows to over $16,000 in 10 years without a single additional deposit. Now, run the same 10-year calculation at 0.01% APY. Your balance reaches $10,010. The compounding effect at near zero rates is statistically invisible. The difference between these two trajectories isn't luck, it's account selection. In Auravale, this is what separates the gleaming spires of Compound Heights from the flatlands below. The residents of Compound Heights chose FDIC-insured HYSAs, compounding daily, and index funds with decades-long horizons. Specific structural decisions, not higher incomes, that account for the gap in their district's skyline. Here's a counterintuitive twist. Many people assume the tools of wealth management, including professional financial guidance, exist only for the already wealthy. That assumption is both common and measurably wrong, and it costs ordinary earners real money every year. A 2022 FINRA Investor Education Foundation survey found that fewer than 1 in 3 Americans without a college degree had ever consulted a financial professional. Not because advisors turned them away, but because most assumed they didn't qualify. Financial guidance is available at any balance size. The barrier is perception, not policy. Here's the part most people don't expect. Financial advisors help align your financial plan with your personal values, not just optimize numbers on a spreadsheet. Your goals, your timeline, your risk tolerance all shape the strategy. The math serves the life, not the other way around. Once your emergency cash is working in a high-yield savings account, the next concept Aravel citizens learn is investment diversification, spreading money across different asset categories like stocks, bonds, and real estate, so that no single market event can wipe out your entire financial position. Consider a specific scenario. Someone holds $15,000 in a traditional savings account, earning 0.01% APY. They move it to a HISA at 4.5% APY. In year one, they earn $675 in interest. Essentially, a free monthly bill payment generated by inertia. Here's the question that stops most people cold. Are these online high-yield accounts actually safe? Yes, provided the institution is FDIC insured. That federal insurance covers deposits up to $250,000 per depositor, per ownership category, per institution. Online banks can offer higher APY for a straightforward structural reason. Without physical branch networks to maintain, no real estate, no teller staffing, no ATM fleets, their operating costs drop, and they pass a portion of those savings directly to depositors. Remember the spread, that gap between what banks charge borrowers and what they return to you? A high-yield savings account narrows it. You capture a larger share of the value your deposited money generates. Shifting from 0.01% to 4 or 5% isn't a small adjustment. It's a structural realignment. Wealth management isn't exclusive to the ultra-wealthy. The HYSA itself is proof. Ally Bank, an FDIC-insured online institution, requires no minimum deposit to open a high-yield savings account. Genuine compounding returns, accessible to anyone with an internet connection and $1 to start. Most people underestimate the cost of not planning, and that underestimation compounds on its own schedule. Every month spent in a 0.01% account, while inflation runs at 3%, is a month of silent, invisible loss that can't be recovered retroactively. The FDIC's 2023 National Survey of Unbanked and Underbanked Households found tens of millions of American households holding cash in low-yield accounts. Aggregate foregone interest, the difference between what depositors earned and what competitive rates would have paid, runs into the hundreds of billions annually, flowing to institutional balance sheets instead of household ones. The system only works against you if you let it. The individual lever here is real and immediate. Unlike stock market returns, which are uncertain, the interest rate differential between a traditional savings account and a HYSA is locked in from the moment you open the account. So why do most people never switch? In 1988, economists William Samuelson and Richard Zeckhauser published research in the Journal of Risk and Uncertainty documenting status quo bias, the measurable human tendency to accept the current arrangement as default, even when a better option requires minimal effort. The bank counts on exactly that tendency. The practical path forward has 3 steps. Step 1. Identify FDIC-insured high-yield savings accounts currently offering 4% APY or higher. Comparison tools like Bankrate and NerdWallet publish updated rate tables weekly, stripping out the research burden entirely. Step 2. Open the account. Most FDIC-insured online HISAs can be opened in under 10 minutes with a government ID and routing number. The new account begins accruing interest, compounded daily, credited monthly, from the first business day of deposit. Step 3. Treat the HYSA as your liquid emergency fund, 3 to 6 months of living expenses, while directing longer-term savings toward diversified investments. The HYSA isn't the destination, it's the foundation that makes the rest of the structure stable. Here's the number that makes this concrete. If you held $10,000 in a 0.01% account for the past 5 years, while a HYSA averaged 4% annually, you left roughly $2,000 of interest on the table. That's not a rounding error. That's a flight, a car repair, or 6 months of groceries surrendered to institutional inertia. The single most impactful financial move most Americans can make this week costs nothing, takes 10 minutes, and starts compounding immediately. Move your idle cash from a 0.01% account into an FDIC-insured high-yield savings account, and let the spread finally work for you.